What's up, guys? Dwight with Defying Finance. I wanted to talk to you real quick about kind of the numbers that just came out in the housing market. I know I've made a couple of videos just recently about that on my walk. I watched Meet Kevin's video today, and there are a couple things I disagree with there. And I also want to show another video that I was in before with George Gammon, kind of some of the things I had asked in that video. I don't even know when that was, maybe 5 or 6 months ago now, just about the housing supply and how that might change. It's starting to happen. So let's go to the other screen here and we'll take a look. Let's move me over here. So the first thing I want to bring up is the pending home sales fell 3.9% in April as the market confronts higher mortgage rates. That I believe is true. We have mortgage rates climbing. The Fed hasn't really raised rates that much. It's 75 basis points. We're not even at 1%, right? I mean, this is really crazy if you think about it. But the market they're the ones that are forcing these rates up, right? So they're sort of doing the Fed's dirty work is what I'm calling it, right? The Fed can jawbone all of this stuff to make it seem like they're going to blow rates through the roof like Paul Volcker did. And the market's reacting to that. Now we'll see if the Fed continues to do that. But here's the deal. So the report comes 2 days after the new home sales slumped nearly 17% in April. Sales of new homes are down about 27% from a year ago. Now, this is a big deal because the new home sales, they include, as I talked about in one of my other videos, everything that's going under contract. So even if you're buying a new home, it's going to be built. Maybe it takes a year to be finalized and built, right? You're waiting to get your loan on that property. But as interest rates are climbing, right, it's up maybe 2% since some of these people have bought these homes. They count those as sold, okay? But you can still cancel that contract. So that makes it look like the supply is lower than it is. It's just like the shadow banking system where you had the shadow inventory of real estate back in 2009, 10, 11, right? They weren't dumping that out there on the market. It's the same type of idea. They're building these homes. There's housing starts, right? They start to break down. They call it a housing start. Then there's a sale of this property. They're going to build. And then you finally come through, you finalize your contract, you get your loan. Well, what happens if you pull out before then, right? Now you have revisions on all these prior months' home sales. So you start seeing, oh, we sold 700,000 homes. This is great, but nobody's living in them yet. Those homes aren't even done. And all of a sudden, let's say 200,000 people cancel those contracts because their payment from when it was started to when it's going to end, now their payment's going to go up 700 more a month. They didn't plan for that, right? A lot of these people were buying because they thought, oh, the housing market's going to keep going up, right? This isn't another 2008 situation. So they're going to get this equity. Well, they're finding out real quick that equity is going to evaporate. It's not going to be there. It's phony wealth, right? Two people sell their homes down the street and it resets the prices for the entire market. It's crazy to think that all that equity is going to be there for you in a time like this. The prices have gone up too quickly. And a lot of that is because the Fed has pushed interest rates down so low for so long. It's just like when Alan Greenspan had did the same thing after, the dot-com bubble. We created the 2008 bubble, right? Same situation. So let's go back over here. So 27%. Let's pull up. I have another article here. Actually, I'll pull this one up later. But I want to pull up this monthly supply chart. Now, I was on George Gammon's show. I talked to Joseph Wang and George here. One of their episodes, you can go look this up. It's towards the end of it. I called in and I was asking them a couple different questions about the market, but I brought up a point about the Fed's monthly supply. Now, George brought up a really good point too about this, where it's not really dividing up like which ones out of the supply are 3-bedroom, 2 baths, right? Which ones are these 6-bedroom homes, right? It doesn't really do that, which is a very good point. But the idea is it gives us a broad picture in the United States with the true supply, right? Because that ultimately is going to decide the psychology of the buyers in your market. Okay, I know it's on a national scale, and these charts are, and real estate is localized, but you have to admit the psychology play will affect your local market. Of course, there's credit issues, all kinds of other things that can happen and affect that as well. But looking at this, when I called in with George, it was right about this 6.5 level here, and now it's just spiking. Okay, this point now it's at 9 months supply, a 9-month supply on the market. Okay, this is big. Last time it was even up near here. Let's see, that would be 2010, right around there, right? So if we go back, you have to go back to 1991. Look at that. I can't even get to the point of that thing. 9.4. Now, I think this is going to continue to climb. As people cancel those contracts, you're going to see this number spike because technically they aren't really sold, right? They can go to D.R. Horton or Lennar Homes, say, nah, I can't afford that payment. I'm not going to go through with the loan. It's another $700-800 a month. I didn't plan on that. And it looks like housing's going down, right? They don't want to be the buyer at the top, so they're pulling out that earnest money deposit that's coming off of the balance sheet of D.R. Horton, Lennar, all these places, and all of a sudden, now it counts as supply on the market. You're going to continue to see that. I wouldn't be surprised if we end up having a giant supply come rolling in because of that math. But anyway, you could check that out inside this video here. I was watching Meet Kevin's video, and I disagree with a couple of things he was talking about. Let's see if I can remember them off the top of my head here. First thing he was talking about just wealth in general, right? You have I think he's something like $175,000. The average home owner has $175,000 in wealth, something like that, and someone who's a renter has $5,000. I think what he is implying off of the data he's getting that from is if you own a home, because he said right after this is why you want to own a home. If you own a home, you have this equity, and therefore, you're wealthier. These are home buyers that can continue to hold their homes. They have better credit and this type of thing. But again, it goes back to that phony wealth, right? Who cares if on paper it says money's there? The idea really is touch it. I dare you, go ahead, touch it. See if you could actually get it out, right? And you might find out real quick that you can't. And even at that, you'd have to minus part of that off. Maybe it's maybe you have a $500,000 home. You paid $250,000 for it. And if it's going to cost you 10%, like he talks about in his video, if it's going to cost you 10% to sell that, to go through all your closing costs, pay your agent, all this type of stuff, well, technically you should be minusing that out of that wealth too, right? So if you think about it, it's not really there. So that number isn't really that consistent. And a lot of these people are going to find quickly as these prices start to drop that wealth's not there anymore, right? So that's really a hard number to go by. One of the other things he does mention in the video was about the new home sales, and I think he did mention something along the lines of what I did, how this includes homes that are sold from places like D.R. Horton that aren't built yet, and that can change. Existing home sales, I still think is a better number to go after. But there's a couple other things I disagreed with him on. But he is turning now. He's turning more bearish, I think, on the housing market as a whole. Obviously, he knows what he's talking about with real estate in local pockets and and how this is probably going to play out. He understands that in places like Austin, they're probably going to see a larger downturn. Places like Boise, Idaho, they're probably going to see a larger downturn. Maybe even Atlanta, Georgia, right? There's places where prices have gone up way too high, and I know the supply of buyers coming in really can affect that. Like if you had a smaller area like Coeur d'Alene, Idaho, populations like 47,000, something like that. Well, sure, if you have 5,000 people move to that area, that's a 10% increase in the population. I mean, that's actually pretty easy to do. If you have a bunch of people move from California or Washington or Oregon right there, 5,000 people isn't really a lot of people, but for that area, that can eat up housing supply quickly. Now, I think in Coeur d'Alene, for example, I think it had fallen about 17% for the supply, while Boise's supply is just exploding. So I would expect Boise, Idaho to really experience a pretty significant fall. There's a lot of areas like that. It's not as bad in areas of California that you would think. So many people are leaving, but you have to consider that homes are becoming very unaffordable. Ask yourself this: if you make 60 grand a year, and let's say your household income is 100 grand a year, can you really afford a house in your area? If your gross income, now forget credit cards, forget car payments, if your gross income was $100,000 a year, is your mortgage only going to be $3,000 a month? Right? Because that's that 30% mark that a bank is really looking for. Well, what you're starting to find out is people are spending 50-60% of their income on their mortgage. Right? That's a problem. So you're going to see that change. Those could turn into foreclosures that fall on the market and continue to increase that supply that we're talking about here, right? Now, that also doesn't change with investors. What if these big investment funds start to dump their real estate on the market? They start seeing stocks and say, hey, stocks are beat up really bad. Let's go buy these stocks, sell these homes because they're falling slower, right? They continue to sell out of those homes, dollar cost average into the stock market and make some great returns, and they can move back into real estate later, right? These are real investors. They have a different mindset. You know, they're not looking to buy the way that you might buy your home and want to live in it. They need a return, right? But if the cost of repairs on that home are going to eat up their returns, or rent controls are going to eat up their returns, they're going to dump the houses, right? So we'll have to see where that goes as interest rates continue to rise. I know they kind of leveled off with the 10-year. We'll see if that continues to go up. What I think is going to happen with that is as people, fly out of the stock market and they jump into the treasury market to get some sort of yield, even though we have 8.5% inflation. We'll see where this goes annualized over the year, but they're flying out of their stocks into these treasuries. And my question is, I wonder if this would be a great plan or a great time for them to start selling treasuries back into the market as the rest of the market is panicking and they're looking for a place to put their cash. As stocks are falling, they're trying to dump them into something else, right? So as people are running into the market, the Fed is dumping that bag on them. I guess we'll see what happens with that. But my real question inside this video, I end with that, is about the Federal Reserve. Now, this is a very big deal for all of us, okay? So let me pull this up by Mishtalk. So this is a good write-up. I'll make this bigger so you can see it. The Fed now owns nearly 1/3 of all U.S. mortgages, okay? So think about this for a moment. What if the Federal Reserve, now obviously they don't want to be a property manager, but let's say all hell breaks loose in the market. We just had a COVID issue and we saw what happened. What did they do? I mean, for the first time ever, this is nuts. I mean, in my brain, this is illegal. They can't tell you you don't have to pay your mortgage. That's a private contract between you and a lender. Okay. But people didn't have to pay their mortgages. All right. So there's nothing saying that they won't do something like that again. What if they don't allow banks to foreclose on people? Right. That's basically what they did. If you miss your payments, banks don't get to foreclose on you. I don't even know what they'll say. Maybe they'll call it a matter of national security if we end up with some sort of situation with China. I have no idea what kind of crazy thing they're going to do. But this is really important to think about. Okay. If the Fed owns that many mortgages, okay, they probably own your mortgage. Let's say you're one of these people out there who think you're not going to be able to make this payment here in the future. So what if the Fed tells you this? They say, okay, I understand, Johnny. You paid $500,000 for your house. We bought your mortgage from this bank. What can you afford? Right? And you say, wow, I could afford a payment around X. And they say, well, what if we forgave that debt? So they destroy some of that money supply. They make it look like it's dropping. Or what if they say this? What if your mortgage is, I don't know, $3,000 a month? Okay, you can't afford that. You still have a job. But what if they decide to rent back to you? They say, okay, here's what we're going to do. We're going to kill your mortgage. We're just going to take ownership of the property. We own the loan anyway. How about you just pay us $1,200 a month? Right? Who's going to turn that deal down? Like, you'd be crazy to turn it down, financially at least. So now you get to rent that same house you're living in. You don't get to own it. Right? Starts to sound a little bit like Klaus Schwab, right? You don't own it, but you're happy because your payment's dirt cheap. You can't rent anywhere in your market for that square footage, for that type of home. So guess what? You're not moving. But the investor next door, right? The investor next door owns a home and he has to rent it at $3,000 a month or $2,800 a month to even begin to cash flow. What's he going to do? Right? So you can see where this is going. If they own that many mortgages and we go into a real crisis, they could have somebody else manage those properties. They could hire property management companies around the United States to manage those properties. Maybe the government even has some sort of subsidy or something. I don't know. And everybody would buy into it because they're the homeowner. They don't want to lose their home. They'll say it's a great idea, which is kind of hypocritical if you think about it. You have all these young people out there, right? They have their loans on their school, and they all want it to get paid off by the taxpayer. But then you have all the older generation saying, I paid my way through college, or I paid my kids' way through college. That would be ridiculous. But then you have those same people coming and saying, yeah, maybe you should forgive part of my loan. And it's just ridiculous, right? It's the same thing. People are going to be lovers of themselves in the end. That's what the Bible says. So maybe that's what's actually going on here. But think about that. What if the Fed not only becomes the largest owner of mortgages in the United States, but what if they control the rental market? Think about that. What if you own a home next door to that guy and you're having trouble making your payments and you decide, man, maybe I should just let this go back to the Fed too. I'd rather pay $1,200 a month instead of $3,000, right? Maybe you put 3% down, you lived there for 5 years, your home's underwater now, and you're like, whatever, I'll just pay a lower payment. That could be a very scary situation. And the Fed could do that because the Fed doesn't have a normal income statement. It's not a business like what you have to operate and what I have to operate. It doesn't work that way. They just print the money out of thin air, right? This is a private bank. This isn't the federal government. It is a private bank. They can take all the losses they want. It doesn't matter. You're not even going to audit the Federal Reserve, right? So think about that for a minute. What if they become the largest property owner in the rental world? It's entirely possible. So I'd be curious. They would probably look like or sell it as if, they're this knight in shining armor that's coming in to save the United States housing market. We'll take it on, guys. Don't you worry. You just pay us a low monthly payment and yada, yada, yada. And it would destroy a lot of debt that's in the system, sure. But I don't know. We'll see what happens. They could even do that with bailing out banks. Banks that start having trouble with some of these mortgages, they can buy those up and do the same type of thing, just to let it all kind of fall on them, and then you pay them rent. So you'll own nothing and like it. That's what Klaus Schwab says. Anyway, let's one more thing I want to pull up here before I go. So this is the S&P Case-Shiller U.S. National Home Price Index, but I want to actually edit this graph. Okay, let's go here. I want to see change from a year ago. So this gives us a more realistic view of the price change nationally year over year. Like from a year ago, how quickly has this changed? Now you can see what happened. This is completely unrealistic. Look what happened when Greenspan dropped the interest rates, right? We had the dot-com bubble. We go through this recession. He drops the interest rates, and look at this climb that we have here into our housing bubble. Look at this, right? Now we did print a lot of money in a sense, or created credit, and these banks lent it out. That's expanding the currency supply. So there is a lot more currency in the system. So nominally, I guess you you could see a higher number here, but ultimately you get to see on this chart how quickly this has got, way out of hand here. So I would expect to see a fairly big dip here, and I think we have to get into that negative territory in order for this correction to be a real correction to drive some of these prices back down. So I would expect to see housing collapse across the nation. And again, I keep saying that doesn't mean it's going to be everywhere. You might see one area it does drop 5%, like Kevin's talking about, or 10% or something. I believe there are going to be areas in Florida that are just like that. Coeur d'Alene, Idaho, the one I keep talking about, may be similar like that too, right? You don't need that many people to move to that area to keep prices stable. So keep that in mind too. And where's the wealth moving, right? So Coeur d'Alene's a perfect example. If there's wealth moving into that area, people who own businesses, multimillionaires, they will be affected by this, but they still have the money to get there and build regardless, or buy something and do a complete remodel. They're not as affected by the inflation as somebody who makes 50, 60, 100,000 bucks a year, right? So in areas that have that small population, but you have a percentage increase of that population of 5-10%, maybe you don't see prices drop there at all. There are going to be areas where it goes up during that whole time. So that's your job, is to start looking into those areas that will be doing that in that time of crisis. But anyway, if you found that valuable, you know what to do. Like and subscribe. And also, if there is an ad, watch the ad. It's free content. Anyway, I am out of here.